I can guarantee you treasuries, the 10-year treasury won't be yielding 0.5% anymore. It'll reintroduce price discovery into a market. And we've seen over the last 2 weeks with the Dow and the S&P, what happens when the market rediscovers price discovery.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And as you can see, Dave Kranzler couldn't already even get through the intro without giggling over there. Because I was making jokes about the 0.3% yielding U.S. Treasury. So that's got him giddy. But I'm still going to do our quick intro just as a reminder to hit that subscribe button and the notification bell. And all right, quick intro aside, now that we've jumbled our way through that. Dave, I appreciate your time here. I know you're trying to go snap up treasuries with that AAA Moodys. I apologize on behalf of Moodys, my first job out of college, which they probably shouldn't have mentioned, but thoughts on a 10-year treasury when inflation, John Williams of Shadow Stats has us close to 9 or 10%. And yesterday we saw the Treasury, I mean, it was rallying 20 basis points an hour, it seemed like. So what are your thoughts on what we saw, which really a historic day, I think it's safe to say?
Well, I mean, if the Federal Reserve would stop and all the central banks would stop buying their sovereign debt and stop fixing the overnight lending rate, just let the market determine what it was. I can guarantee you treasuries, the 10-year treasury won't be yielding 0.5% anymore. It'll reintroduce price discovery into a market. And we've seen over the last 2 weeks with the Dow and the S&P, what happens when the market rediscovers price discovery. The downside adjustment happens a lot more quickly than the upside movement when the bubble was being blown.
Yep. Yeah, I mean, you would.
Well, I guess my point here is that I don't know, for at least since 2008. I mean, the Federal Reserve's job is to remove price discovery from the Treasury market, but it's been done at varying degrees over the last 30 years. Since 2008, they've basically removed nearly 100% of the price discovery of treasuries. So that's why you had a 30-year bond that was trading well below the real rate of inflation.
Yep.
And I mean, if anyone who's out there managing a treasury bond fund and really believes the CPI is the inflation number, they're complete idiots, and they shouldn't be managing pension money or bond funds, or I certainly wouldn't want friends and family putting money in those funds. Maybe enemies.
As I understand it, I think about 99.5 or maybe 99.9% of the world is investing exactly according to those mandates. It was funny, even towards my last years at Susquehanna, they had a bond desk. It's maybe 2011. They would still actually look at the Moodys Ratings, which I thought was kind of unusual. But another question that comes
Enron was rated AAA by Moody's until about, a couple months before it hit the wall. So that tells you how good Moody's ratings are, or S&P or Fitch.
I mean, Moody's still has the U.S. Treasuries as AAA, saying that it's simply not possible. There's no way it can be done to have a better credit profile than that of the U.S. government, which is amazing in its own right. Although I got a good one for you here that I've been thinking about where, I mean, are we in agreement that a 0.3% yield on a 10-year treasury out of the U.S., I mean, that's an historic event, correct?
Well, I mean,
not a good historic event.
It's not any more historic than negative yields on European sovereign debt.
Well, we'll be talking about that on next week's episode. Although what I'm getting at is that if we review some of these assets like gold or treasuries as a safe haven, so we've seen this incredible rally into treasuries. What would the gold equivalent of a 0.3% yield be? I mean, would that be like if gold were actually trading as a safe haven, like the Treasury? I mean, would that be $5,000 gold, $10,000 gold? I mean, I don't. Maybe you
Well,
could
it's
put
the
it into
same
perspective.
it's the same dynamic with the Treasury market. If the central banks would and the BIS would get out of the business of trying to manage the price of gold and just let the market discover the real price of gold, you'd probably find that not only would Treasury yields go up quite a bit, but the price of gold would go up quite a bit. I have no idea where it would trade. It's not my business to figure out where gold is supposed to trade, other than to know that it should be trading multiples higher than where it is right now. So, it's just like central banks. It shouldn't be their business to set the price in markets. Let the free market decide where things should be trading.
Well, I'm on board with that. Maybe we can get Bernanke to become a subscriber of the Short Sellers Journal, and he could pick up on it, or Powell, or again, I lump them all in as one and the same. Although, thoughts on how much we've seen the stock market go down these last couple of weeks? I mean, as you've been writing about for a while, certainly it was probably quite overdue. Are we seeing this bubble finally start to pop? Or on the other hand, we were already hearing about Fed intervention, central bank intervention, possibly even before next week. Do they print this up, and by election time, nobody even remembers coronavirus and what happened these past couple months in the markets? What do you see happening there?
I mean, just to kind of circle back to the previous segment, if that's what it was, or mode of thought that we're discussing, David Stockman turns it the best. I mean, we live in a system where the Federal Reserve and the government implement free lunch economics as opposed to free market economics. And I mean, he, in his latest article that was published for free on LouRockwell.com, I mean, he said it the best. Coronavirus is now exposing a far more deadly disease, namely the poisonous brew of easy money, cheap debt, sweeping financialization, and unbridled speculation that has been injected into the American economy by the Fed and the Washington politicians. It has turned Wall Street into a dangerous gambling casino while leaving Main Street buried under mountainous debts, faltering investment and growth and productivity, and the hand-to-mouth economics of spending more than you earn. And that sums it up the best. I mean, you read my latest short seller journal, I think. I mean, I assume you don't always read it on Sunday when it goes out, but essentially, coronavirus isn't what caused the market to fall off a cliff over the last 3 weeks. I mean, it might have been the catalyst that exposed all of the rot underneath the entire financial system. So all the coronavirus scare has done is compress the time frame into which we saw a large decline in the stock market, and the stock market is still extraordinarily overvalued, even after, I guess, the Dow has fallen about 16% from its top to where it is now. So those market forces were brewing underneath anyway, and they were going to impose themselves on what the Fed has done in its attempt to hold things up, and Trump's attempt to hold things up. They were going to impose themselves, sooner or later. And coronavirus was kind of like, the tide going out on King Canute. So, that's basically what's happened. And I love all these people coming onto Bubble Vision, mainstream financial media, begging for the Fed to interfere. The Fed needs to buy stocks now. I mean, these guys only know how to operate in a system where the stock market only goes one way, and that's up. But I got news for you. That doesn't happen forever. Whether it's going to be the extreme devaluation of the currency that undermines the stock market, or something like the coronavirus, an exogenous the coronavirus could be your proverbial black swan event. No one saw that coming. I mean, we've seen everything else coming. The Fed saw something coming in September, and it wasn't coronavirus, right? And what was supposed to be a short-term temporary injection of liquidity into, to facilitate overnight repo lending, all of a sudden has blossomed into, now they're doing, the repo operations are 150 billion twice a week. Those are the overnight repo operations. Or no, those are every day up to 150 billion. And the 2-week quasi QE repo operations have more than tripled in size, so, and that's not coronavirus. There's something much more profound and destructive going on. And it's the same type of issues that colluded to undermine the markets in 2008. And it's largely related to subprime credit and derivatives. And it's worse this time around than it was back then.
Yeah, unfortunately, that is the case. Although, as you point out, every response they offer, whether it's the IMF with their 50 billion or Trump's talking about economic measures to combat coronavirus, I mean, somehow it's going to be some form of printed or borrowed money as the solution, which again is why folks
printed money and borrowed money are one and the same now.
Yeah. Yeah, I don't even think there's anyone out there still lending to the U.S., which makes you really wonder how much of this is being printed that we're not told about. But again, is why so many look to the gold and silver markets, which you cover in your short mining stock journal, in addition to the short sellers journal. And with that said, Dave, I appreciate the quick update. I know people are wondering what the heck's going on. And for anyone who is looking towards the gold and silver market and wondering why that hasn't taken off, just stay tuned, because the video about to appear is Dave explaining what's going on with those gold stocks. So that's coming right your way. And Dave, thank you as always for joining me today.
Thanks for having me on. Always a pleasure, Chris.